The quiet coup at the Federal Reserve is already underway, signaling a massive loss of independence that could trigger the next global liquidity cliff.
That is exactly what former Fed advisor Danielle DiMartino Booth and Eurodollar expert Jeff Snider are tracking as the financial plumbing begins to seize up.
We have used AI to condense hours of high-stakes analysis from Danielle, Michael Saylor, and Lance Roberts into this single, time-saving briefing.
Stay tuned as we reveal the $2.2 trillion debt wall and why Michael Saylor is preparing for a $13 million Bitcoin future.
Look, the biggest story in finance isn't just interest rates anymore, it's the quiet coup pour. Danielle DiMartino Booth and Tom Bodrovics just broke down regarding Kevin Warsh and the Fed.
Exactly. Danielle believes we might be seeing a move to install Kevin Warsh as a sort of shadow Fed chair, potentially operating from the Treasury to bypass traditional independence.
Wait, a shadow chair? Like he's running the show from the basement of the Treasury building?
Not quite the basement, but Danielle notes that having a figure like Warsh in a dual capacity role could fundamentally shift how the dollar is managed.
And while this shift might sound like a political win for some, Danielle warns it could lead to a massive loss in Fed independence.
Is independence really that big of a deal? I mean, who doesn't want lower rates?
It matters when the markets lose trust. We'll get into why Danielle thinks this could trigger a crisis later, but first, let's look at the mechanics of this coup.
If the Fed becomes just another arm of the executive branch, all the old rules for the S&P 500 go out the window. Danielle DiMartino Booth is drawing a straight line back to the 1951 Treasury Fed Accord to explain what's happening now.
Right, that was when the Fed finally broke free from being the Treasury's piggy bank after World War II.
Hold on. So the Fed used to just be a credit card for the government?
Basically, and Danielle's concern, which she discussed with Tom Bodrovics, is that we're heading right back to that dynamic.
If Warsh takes over, the goal might be to keep interest rates artificially low to fund massive government deficits.
So basically, the government wants to borrow more and pay less for it. Sounds like a recipe for inflation.
Danielle highlights that Kevin Warsh isn't a newcomer. He was the youngest Fed governor ever at 35.
He's an institutionalist who knows where the bodies are buried. Danielle argues his return isn't just about a job, it's about a total policy overhaul.
Wait, 35? I was barely managing my own checkbook at 35.
That's why Danielle thinks he's the perfect candidate for this quiet coup. He knows how the machine works from the inside.
Exactly. He's not there to learn. He's there to execute a vision that Tom Bodrovics noted aligns closely with a more aggressive executive branch.
Does Danielle think the 2% inflation target survives this takeover?
Unlikely. Danielle suggests that if the Fed is subsumed, that target becomes a secondary concern to managing the national debt.
So the 2% is just a suggestion now. What happens to my grocery bill?
It means inflation could stay sticky for much longer than the markets currently expect.
Basically, political goals are going to override economic stability if this play works.
Great. Politics and my wallet, always a fun combo.
Danielle also mentioned the internal friction at the Fed. There are over 400 PhD economists there.
Right? And most of them are wedded to the current model. Danielle thinks Warsh would face a literal civil war inside the Eccles building.
400 PhDs. That's a lot of elbow patches and spreadsheets to fight through.
Exactly. If Warsh tries to dismantle the current consensus, expect massive leaks and institutional pushback.
But as Danielle pointed out to Tom, that pushback is exactly why a shadow role might be more effective than a direct appointment.
If this shadow Fed takes hold, Danielle sees a path for aggressive rate cuts regardless of inflation data.
She's looking at a potential 50 basis point cut if the administration needs a market boost.
50 basis points. That sounds like a lot of juice for the stock market.
It is, but Danielle warns it's a short-term sugar high with a long-term inflation hangover.
So more volatility for the 10-year yield as the market tries to figure out who's actually in charge.
So the charts are going to look like a heart monitor. Got it.
What does Danielle think this does to the US dollar?
She believes it's an institutional stress test. If the world thinks the Fed is no longer independent, the dollar's reserve status takes a hit.
Wait, if the dollar drops, does that mean my international vacation just got way more expensive?
Exactly, and your gas and your imported electronics.
Danielle's perspective is that this coup could inadvertently accelerate the global move away from the greenback.
Danielle's main takeaway? Watch the 10-year Treasury yield like a hawk.
If the yield spikes while the Fed is trying to cut, it means the bond market is revolting against the shadow Fed.
So if the numbers on my screen go up when they're supposed to go down, that's the red flag.
Precisely. It's the market saying, we don't believe you're independent anymore. Finally, Danielle and Tom suggest keeping a close eye on Treasury personnel announcements.
If Kevin Warsh gets any role that isn't strictly ceremonial, the quiet coup is officially on.
So I should basically set a Google alert for Warsh and Treasury.
That's exactly what Danielle DiMartino Booth would tell you to do if you want to protect your portfolio.
The era of Fed independence is on trial. Make sure you're watching the right evidence. Matt DeWolf is highlighting a massive divergence today. The market is sitting at all-time highs despite no peace deal in Iran.
It's the ultimate ignore the noise move. Matt notes that even with the geopolitical tension, the technicals are overriding the headlines.
Wait, no peace deal? Aren't we supposed to be worried about oil or, I don't know, a wider conflict?
You'd think so, but Matt's analysis shows the S&P 500 is basically shrugging its shoulders.
The alpha here is that liquidity is currently more powerful than fear. But watch out, Matt found a specific trapdoor level in the QQQ that we'll break down in a minute.
A trapdoor? Well, that sounds terrifyingly efficient.
Matt DeWolf's core thesis is simple. As long as the SPY stays above 5,500, the bull run is intact.
Exactly. He argues that trying to trade based on Middle East news right now is a fool's errand compared to watching that price level.
So 5,500 is the magic number. What happens if we hit 5,499?
Then the party's over. Matt suggests that would be the signal that the geopolitical risk is finally being priced in.
It's about the momentum. Matt points out that the dip buyers are still incredibly active at these heights.
So we're all just standing on a ledge, hoping nobody sneezes?
Matt notes that Nvidia is still the engine in this car, up another 5% this week.
He's watching the $130 level closely. If that holds, the entire tech sector stays afloat.
5% in a week. Is that normal, or are we just living in a simulation now?
In this market, it's the new normal. Matt thinks the AI trade is still providing the safety that gold used to.
So chips are the new gold? Can I make jewelry out of a GPU?
Maybe not, but Matt's data shows it's where the big institutional money is hiding.
Looking at the QQQ, Matt DeWolf identified $480 as the critical resistance level.
He mentioned that the volume at that level is thinning out, which could mean a breakout or a violent rejection.
Thinning volume? Does that mean people are getting bored, or they're scared?
It means conviction is low. Matt says the market is waiting for a catalyst, likely from the Fed or an actual Iran update.
So we're basically stuck in a range until someone blinks.
I'm great at blinking. Not so great at waiting.
While big tech flies, Matt points out that the small caps in the IWM are actually down 2%.
That divergence is a warning sign. It shows that the rally isn't as broad as the index price suggests.
Wait, so if the small companies are failing, isn't that bad for the actual economy?
Usually yes. Matt believes this K-shaped move is driven by high interest rates hitting smaller firms harder.
It's a top-heavy market. Matt's advice? Don't mistake the S&P's performance for the health of the average business.
So the giants are winning, and the little guys are struggling. Classic.
Here's a twist. Matt DeWolf predicts that if a peace deal is actually signed, we might see a sell the news drop of 3 to 5%.
It sounds counterintuitive, but the market often prices in the hope and then exits once the certainty arrives.
Hold on, so peace is bad for my 401k?
Short term? Maybe. Matt thinks the risk-off trade would move money out of stocks and back into bonds.
Exactly. The tension creates a premium that vanishes once the problem is solved.
The stock market really is just a giant emotional roller coaster, isn't it?
On the bullish side, Matt sees the S&P 500 potentially testing 5,650.
His reasoning is based on the upcoming earnings cycle. If the big tech names beat expectations, the geopolitical noise won't matter.
So we could actually go higher, even from all-time highs?
Matt thinks there's still a fear of missing out among institutional investors who are underallocated.
The trend stays up until it doesn't. And right now, Matt's trend lines are pointing north.
I'll pack my hiking boots for 5,650 then.
Matt DeWolf's actionable takeaway. Set your stop losses at 5,480 on the SPY.
That protects you if the trapdoor opens. If we break that, Matt expects a very fast slide.
So 5,480 is the get out of town signal.
Precisely. It's the level where the technical structure fails.
He also suggests staying focused on high-volume semis like Nvidia and AMD.
Matt notes that volume is the best indicator of truth in a market full of headlines.
Watch the volume, watch the chips, and don't panic about the news. Got it.
Spoken like a pro. Matt's approach is all about discipline over drama.
Less drama, more data. I can get behind that.
Today we are looking at Michael Saylor's latest discussion with David Lin, where he dropped a bombshell. MicroStrategy is no longer just a software firm. It is now a Bitcoin development company.
That is right. Saylor is essentially turning the company into a factory that produces Bitcoin yield for its shareholders. While other companies hold cash, Michael Saylor is doubling down on Bitcoin as the primary engine of growth.
Wait, a Bitcoin factory? Are they actually mining it now or just buying more?
Neither, really. They are using their equity and debt to accumulate Bitcoin in a way that increases the amount of Bitcoin held per share. It is a total pivot from their original business model. According to David Lin's conversation with Michael Saylor, the core of the strategy is something they call Bitcoin yield. This year alone, they hit 6.7%.
Exactly. Saylor explains that by issuing stock and using that capital to buy Bitcoin, they are increasing the Bitcoin per share ratio. It is like a dividend, but paid in the world's scarcest asset.
Hold on, 6.7%. That is better than most high-yield savings accounts right now. But with Bitcoin?
Exactly. But remember, this is about the growth in Bitcoin holdings per share, not just cash in a bank.
It is a bold move. While some call it risky, Saylor argues it is the only way to avoid the slow death of corporate cash reserves.
So they are basically outperforming the dollar by just existing as a Bitcoin proxy.
The title of the video mentions a historic move to sell. Did Michael Saylor actually say he is selling his Bitcoin?
Not exactly. In his talk with David Lin, Saylor clarifies that he would only sell if Bitcoin's fundamental properties changed, like if it stopped being decentralized or secure.
Wait, so the prepared to sell part is basically a never going to happen scenario?
Precisely. Saylor views Bitcoin as the apex property. To him, selling Bitcoin for dollars is like trading a house for a pile of melting ice.
So the historic move is actually his commitment to never selling unless the entire network breaks.
That is a pretty high bar for selling. I guess my $5 in Bitcoin is safe then.
Michael Saylor pointed out a staggering stat to David Lin. MicroStrategy has outperformed every single company in the S&P 500 since they started the Bitcoin standard.
It is true. Since August 2020, their stock is up over 1,000%. Compare that to the tech giants or even the index itself.
1,000%. That is insane. Why is not every company doing this?
Because it takes nerves of steel to handle the volatility. Most CEOs are too scared of a 30% dip to see the 1,000% gain.
Saylor calls it volatility for performance. If you want the gains, you have to embrace the roller coaster.
I think I will stick to the roller coaster at the theme park. Thanks. But the numbers do not lie.
How is Michael Saylor actually pulling this off without blowing up the company?
He explains to David Lin that they use intelligent leverage. They issue convertible notes with tiny interest rates, sometimes as low as 0.6%, to buy more Bitcoin.
Wait, they are borrowing money for almost free to buy an asset that goes up 40% a year?
That is the play. It is a massive arbitrage. They are borrowing weak money to buy strong money.
But what happens if Bitcoin crashes? Does the whole house of cards fall down?
Yeah, that's what I'm worried about. Is not that just gambling with borrowed money?
Saylor argues that because the debt is long-term and not callable, they can just wait out any bear market. They have no margin call risk.
Michael Saylor's long-term outlook is even more aggressive. He told David Lin he expects Bitcoin to hit $13 million per coin by 2045.
He bases that on Bitcoin capturing 7% of global wealth. As institutions and nation-states realize it is the best way to preserve capital, the price has nowhere to go but up.
13 million. Is that even possible? There is not that much money in the world.
There is if you factor in inflation and the total value of real estate, gold and bonds. Saylor sees Bitcoin eating all of those asset classes.
So we're talking about a total global financial reset, where Bitcoin is the baseline.
If he is right, I really need to stop spending my money on lattes and start buying Satoshis.
Saylor predicts that MicroStrategy will eventually be seen as the ultimate Bitcoin index fund.
Exactly, because they can generate that Bitcoin yield we talked about. He believes investors will choose MicroStrategy over a spot ETF because an ETF just sits there, while MicroStrategy grows its holdings.
So it is like a Bitcoin ETF, but on steroids?
In a way, yes. It is an actively managed Bitcoin treasury that pays you back in more Bitcoin per share.
It is a bold prediction that assumes the market will continue to value their yield over just holding the coins directly.
I guess we will see if the Saylor premium holds up in the next bull run.
So, if you are following Michael Saylor's lead, what should you actually watch?
Saylor's strategy depends on the market's willingness to pay a premium for MicroStrategy stock relative to the Bitcoin they hold. If that premium disappears, the leverage model slows down.
So I should check the NAV or net asset value regularly.
Exactly. It is the key metric for understanding if MSTR is overvalued or a bargain compared to just buying Bitcoin.
And keep an eye on those debt offerings. If they can keep borrowing at low rates, the Bitcoin factory keeps humming.
Got it. Watch the debt, watch the premium, and maybe don't sell your Bitcoin for a sandwich.
We are breaking down a heavy one today. Jeff Snider, the lead researcher at Eurodollar University, has issued what he calls a grim warning to the American economy.
Yeah, and Jeff isn't just looking at the surface, he's diving into the Eurodollar system. That's the massive shadow banking world that actually runs the global economy.
Wait, Eurodollars? Are we talking about currency in Europe, or is this more complicated?
It's way more complicated. It's essentially US dollars held in foreign banks, and Jeff Snider argues they control the global pulse way more than the Federal Reserve does.
Exactly. And his point is that this system is flashing red for a massive liquidity crunch.
Jeff Snider's central thesis is that we aren't heading for a soft landing. We're heading for a monetary cliff because the global dollar supply is essentially evaporating.
Right, while everyone is focused on the Fed raising or lowering rates by 25 basis points, Jeff is watching the actual plumbing of the system fail.
Hold on. If the plumbing fails, does that mean ATMs stop working or something? What's the real-world hit here?
It means banks stop lending to each other, which means they stop lending to businesses, and suddenly the whole engine stalls out.
And Jeff Snider highlights that this isn't a theory. The data in the repo markets is already showing these cracks. Jeff Snider points to the yield curve inversion as the ultimate smoking gun. The 2-year and 10-year treasuries have been inverted for a historic amount of time.
Exactly, that inversion is basically the bond market's way of screaming that the future looks much bleaker than the present.
Wait, I've heard this inversion thing before. Does it always mean a recession is coming, or is this time different?
Jeff would say it's never been wrong. When the bond market pays you more to lend for 2 years than 10 years, the system is fundamentally broken.
And it's not just the US. Jeff Snider notes that global curves are following the same path from Germany to Japan. Jeff also brings up bank credit data. Commercial banks are tightening their belts and pulling back on lending at rates we haven't seen since the great financial crisis.
That's a huge point. If businesses can't get loans, they can't expand, and they definitely can't keep all their employees.
So if banks aren't lending, is that why I'm seeing more empty storefronts lately?
Precisely. It starts at the top with these big institutional shifts and trickles down to your local Main Street.
Jeff Snider warns that this credit freeze is the precursor to a major spike in defaults. Here's the scary part. Jeff Snider argues the Fed is actually powerless. They can print bank reserves, but they can't force banks to lend dollars they don't have.
It's like having a car with a full gas tank but a broken engine. The Fed provides the gas, but the Eurodollar system is the engine that's seized up.
Wait, so Jerome Powell isn't the guy with the magic money button?
Jeff says no. He believes the money printing narrative is a myth because the Fed only controls a tiny fraction of the global monetary pie.
So when the shadow banks panic, the Fed is essentially just watching from the sidelines. So what's the end game according to Jeff Snider? He's predicting a deflationary shock, not the runaway inflation everyone else is worried about.
Right? When the liquidity disappears, people are forced to sell assets to get cash. That drives prices down across the board.
Deflation sounds good for my grocery bill though, right? Cheaper eggs?
Only if you still have a job to pay for them. Jeff warns that deflationary busts usually come with a huge wave of layoffs.
He expects a major correction in both the stock market and real estate as the dollar shortage intensifies.
Jeff Snider also predicts a significant jump in unemployment, potentially up 2% as the credit crunch hits the real economy.
Yeah, he notes that corporate earnings are already under pressure. Once the credit lines dry up, the layoffs begin.
2%? That sounds small until you realize that's millions of people losing their paychecks.
Exactly. It's a massive shift in the labor market that the soft landing crowd isn't prepared for.
Jeff's data suggests the lag time is closing, and we'll see this hit by late this year. So what do? Jeff Snider says, watch the 10-year treasury yield like a hawk.
If you see yields plummeting, it means big institutions are panicking and piling into safe haven assets.
So, if the yield goes down, that's my signal to be worried about the stock market.
Usually, yes. It's the ultimate risk-off signal in Jeff's playbook.
Jeff also suggests tracking commercial bank credit reports. If those numbers stay negative, the economy has no fuel.
Keep an eye on the H8 report from the Fed. It shows exactly how much banks are lending to the public.
H8? Okay, I'll add that to my boring but important reading list.
It might be boring, but Jeff Snider's analysis says it's the only way to see the cliff before we drive over it. Ken McElroy is sounding the alarm, claiming the 2026 crash hasn't just been planned, it's already in motion.
Ken's focus is on the $2.2 trillion in commercial real estate debt, hitting a wall of high interest rates very soon.
Wait, 2.2 trillion with a T. Is that even a real number, or just something we made up to be scary?
It's very real, and Ken argues it's the single biggest threat to the economy right now.
The alpha here is that Ken McElroy believes this crash will create more millionaires than any other period in history if you have cash ready.
So it's a bad news for them, good news for me situation if I'm not broke.
Exactly. But while Ken is bullish on the opportunities, he also warns about a massive risk in the banking sector that could wipe people out first.
We'll dive into those bank risks in a bit, but first, let's look at why Ken thinks the math just doesn't add up for landlords anymore.
According to Ken McElroy, the core issue is that properties bought at 3% interest rates are now being forced to refinance at 7 or 8%.
Ken points out that these owners simply don't have the cash flow to cover a doubling of their interest payments.
Hold on. If my mortgage doubled tomorrow, I'd be living in a tent. Is that what's happening to these big office buildings?
Pretty much. Ken says many of these owners will have to hand the keys back to the bank.
Ken McElroy highlights that multifamily properties, your standard apartment complexes, could see valuations plunge 30%.
That's because cap rates are rising. When interest rates go up, the price investors are willing to pay goes down.
Wait, if the building is worth 30% less, does my rent go down 30% too?
I wish. Ken says it actually means the owner goes bust, the bank takes over and the property gets sold at a discount.
So the building stays, but the owner gets wiped out. That's the crash Ken is describing. Ken also notes that banks are panicking. Lending liquidity has dropped by nearly 40% in some sectors.
If you can't get a loan, you can't buy property, which forces prices even lower. It's a vicious cycle.
So even if I find a cheap house, the bank might just say no to the loan.
Exactly. Ken McElroy argues that cash will be king because the banks will be too scared to lend.
He's seeing regional banks specifically pulling back because they're over-leveraged on these bad commercial loans. Ken McElroy mentions that while inventory is low now, the forced sales will start hitting in 2026 as those loans mature.
What's a forced sale? Is that like a foreclosure?
Basically, it's when the owner can't refinance and can't afford the new rate, so they have to sell, regardless of the price.
Ken believes this will create a massive wave of supply that finally breaks the back of high prices.
So we just have to wait 2 years for the fire sale to start.
Ken McElroy predicts the absolute bottom of this cycle will hit around the middle of 2026.
He bases this on the sheer volume of debt that has to be dealt with by then. It's a math problem, not a guessing game.
So if I'm planning to buy, I should basically set a calendar alert for June 2026.
Ken would say you should be preparing your cash now, so you're ready when the clock strikes 12.
Another prediction from Ken is a massive shift toward a renter nation as homeownership becomes unaffordable for many.
He sees big institutional investors waiting on the sidelines to swoop in and buy these distressed assets.
Wait, so the millionaires Ken is talking about are just going to be our new landlords?
That's his take. The wealth transfer moves from the overleveraged to the cash-rich.
It's a grim outlook for some, but Ken sees it as an inevitable part of the economic cycle. Ken McElroy's biggest takeaway is simple: get liquid. Cash is going to be your most powerful tool in 2026.
He suggests exiting marginal investments now to build that war chest.
So sell my old Pokemon cards and save the pennies. Got it.
If it gets you closer to a down payment on a distressed apartment building, Ken would probably approve.
Ken also advises keeping an eye on local bank health. If your local regional bank is struggling, it's a sign the crash is hitting your area.
How do I even check if a bank is healthy? Do I just ask the teller?
Not quite. Ken suggests looking at their commercial loan exposure in their public filings.
The more bad office loans they have, the more likely they are to stop lending, which triggers the price drops Ken is talking about.
Straight to the point, Lance Roberts is sounding the alarm on a massive deviation in the markets that could lead to a 15% pullback very soon.
Lance's analysis shows that the S&P 500 is stretched so far above its moving averages that a mean reversion isn't just possible, it's overdue.
Hold on, 15%? That sounds more like a crash than a tiny dip. Are we talking about my retirement fund taking a hit?
It's a correction, not necessarily a crash, but Lance points out that when the rubber band stretches this far, it usually snaps back hard.
And while everyone is eyeing the exits for stocks, there's a second risk in the bond market we'll hit in a few minutes. We're looking at insights from Lance Roberts, the chief investment strategist at RIA Advisors, during his recent discussion with Adam Taggart.
Lance is known for his technical deep dives, and he's telling Adam that the current market euphoria is ignoring some pretty grim math.
So he's the guy who looks at the charts while everyone else is just watching the news.
Exactly. He focuses on the data, not the hype, which makes his 15% warning even more chilling. The core of Lance's thesis is that the market is currently 10 to 12% above its 200-day moving average.
Historically, Lance notes that prices always return to that mean. They don't just stay in the clouds forever.
Wait, what's a 200-day moving average? Is that just the average price for the last year?
Basically, yes. It's the long-term trend line. When price gets this far away from it, it's like a magnet pulling it back down.
And Lance told Adam Taggart that this is one of the largest massive deviations he's seen in recent cycles.
So if the magnet is pulling, we're basically waiting for the drop.
Lance Roberts highlights that the market's health is an illusion because it's being carried by just 7 stocks.
The Magnificent Seven. If you take those out, the rest of the S&P 500 is actually looking pretty flat or even down.
Wait, so if Nvidia or Apple has a bad day, the whole market tanks because they're the only ones doing the heavy lifting?
Precisely. Lance argues this concentration makes the entire index incredibly fragile.
It's like a table with only 2 legs. It looks stable until you put a little pressure on it.
That's a terrifying analogy for my portfolio.
Lance also explained to Adam that we haven't actually felt the full weight of the Fed's interest rate hikes yet.
There's a lag of 12 to 18 months. The hikes from last year are only just starting to squeeze businesses and consumers now.
So, the soft landing everyone is talking about Might just be a slow motion crash.
Lance thinks so. He notes that credit card delinquencies and bankruptcy filings are already starting to tick up.
He's watching the data, and it shows the consumer is finally running out of steam.
I guess those inflation-proof savings accounts are finally empty.
Lance points out a structural problem. Passive investing is forcing money into expensive stocks.
Every time your 401k contribution hits, it buys more of the top stocks, regardless of whether they are overvalued.
Wait, so I'm accidentally making the problem worse every payday?
In a way, yes, it creates a feedback loop that pushes prices to these massive deviations Lance is worried about.
And Lance warns that when the selling starts, that same passive mechanism can accelerate the move down.
So it's a ladder on the way up, but a slide on the way down. Fun.
Lance Roberts isn't just saying a drop is coming. He's looking at a 10 to 15% correction in the very near future.
He told Adam Taggart that the technical indicators are maxed out and the market needs to breathe.
If it drops 15%, does that mean I should sell everything right now?
Lance doesn't say sell everything, but he does suggest that holding excessive risk right now is dangerous.
He's predicting a return to the mean, which would put the S&P 500 back toward its previous breakout levels.
So it's more like a reset button than an end-of-the-world button.
Another big prediction from Lance, interest rates aren't going to drop as fast as the market hopes.
Lance believes sticky inflation will keep the Fed from cutting rates aggressively, which will keep pressure on stock valuations.
But I thought the Fed was supposed to save us?
Lance argues the Fed is more worried about inflation returning than they are about the stock market dipping 10%.
Exactly. They aren't going to pivot just because some tech stocks are down.
So we're stuck with high mortgage rates and high grocery prices for a while longer.
Lance Roberts' main takeaway for Adam Taggart's audience was simple. It's time to rebalance.
If you've made huge gains in AI or tech, Lance suggests taking some chips off the table.
So sell high. Finally, some advice I actually understand.
It's about risk management. You don't want to be the one holding the bag when that 15% drop hits. Lance also advises watching the 20-week moving average.
If the market breaks below that, Lance says that's the signal that the correction is turning into something more serious.
Okay, so I'm watching the 20-week average and the magnet for the 200-day. Got it.
Precisely. Stay informed, stay cautious, and don't get blinded by the hype.
Lance Roberts and Adam Taggart always bring the data. We'll see if the massive deviation closes as predicted.
I'm going to go check my 401k and maybe buy a stress ball.
First up, Lance Roberts emphasizes the mean reversion theory, predicting that inflated asset prices will soon correct.
He discusses how this idea suggests that prices will revert to their historical averages, which in light of today's valuations means a significant downward adjustment.
So it's like a spring, right? If you stretch it too far, it's going to snap back? That's a little scary.
Precisely. The longer the prices stay inflated, the stronger that pullback could be.
Next, Ken McElroy warns about the looming debt maturity wall impacting real estate.
He explains that billions of dollars in commercial real estate loans are maturing, and if refinancing conditions worsen, it could freeze the market.
Wait, so are you saying we could face a massive real estate crash if these loans aren't managed properly?
Exactly. If those borrowers can't refinance, it could lead to defaults and a ripple effect across the sector.
Finally, Jeff Snider dives into the Eurodollar liquidity trap, suggesting it's strangling financing opportunities.
He highlights that the Eurodollar system is facing severe stress, limiting liquidity for institutions and ultimately the economy.
So it's like choking the lifeblood of global finance. How can we breathe without it?
Exactly. Without a functioning Eurodollar market, the consequences could be dire.
It's fascinating how all three guests see the same thing, a potential major market correction ahead.
That's right. Regardless of their differing focuses, whether it's market prices, real estate, or liquidity, they all agree it signals trouble.
So everyone's seeing storm clouds on the horizon? That can't be good.
Exactly. It suggests they all recognize signs of impending issues. Another point of consensus is the importance of monetary policy in this current environment.
Absolutely. Each guest emphasizes that central bank decisions will heavily influence market dynamics.
So regardless of their areas of expertise, they're all watching the Fed like hawks.
Exactly. What the Fed does next might dictate the timeline and severity of the correction. This is where it gets interesting. Lance believes we'll see a correction within 6 months.
In contrast, Ken thinks the impact from the debt maturity wall will take at least 12 months to unfold.
Wow, that's a bit of a gap. So one is thinking fast, and the other is taking a more patient approach.
Exactly. The discrepancy lies in their assessments of market dynamics and external pressures. Now here's a classic debate. Jeff claims the Eurodollar liquidity trap is the main hurdle.
Lance, however, insists that inflated asset prices are the more urgent issue we need to address.
Hold on. So it's like one sees a plumbing issue, while the other sees a leaky roof.
Spot on. Both are critical, but highlight different pathways to potential disaster. If you found our expert insights valuable, Don't forget to hit that like button and subscribe for more content.
We aim to bring clarity out of complexity so you don't miss out on key financial takeaways.
Honestly, this breakdown saved me a ton of time, so I'm all in.
Thanks for joining us, and we'll see you in the next video.